2012 and corporate debt coming due. When the Mayans envisioned the world coming to an end in 2012, at least in the Hollywood version, they didn't count junk bonds among the perils that would lead to worldwide disaster. But maybe they should have, because 2012 also is the beginning of a 3-year period in which more than $700 billion in risky, high-yield corporate debt begins to come due, an extraordinary surge that some analysts fear could overload the debt markets. With huge bills about to hit corporations and the federal government around the same time, the worry is that some companies will have trouble getting new loans, spurring more defaults and a wave of bankruptcies. The United States government alone will need to borrow nearly $2 trillion in 2012 to bridge the projected budget deficit for that year and to refinance existing debt. And then there's the unforeseen. Indeed, worries about the growth of national or sovereign debt prompted Moody's Investors Service to warn on Monday that the United States and other Western nations were moving substantially closer to losing their top-notch AAA credit ratings. Sovereign debt aside, the approaching scramble for corporate financing could strain the broader economy as jobs are cut, consumer spending is scaled back, and credit is tightened for both consumers and businesses. Yes, this time it's different. This kind of talk is not limited to perpetual bears and the rest of the doom and gloom crowd. Even Moody's, which is known for its sober public statements, is sounding the alarm. An avalanche is brewing in 2012 and beyond if companies don't get out in front of this, said Kevin Cassidy, a senior credit officer at Moody's. Private equity firms and many non-financial companies were able to borrow on easy terms until the credit crisis hit in 2007. But not until 2012 does a long-delayed reckoning begin for a series of leveraged buyouts and other deals that preceded the crisis. That is because a record number of bonds and loans that were issued to finance those transactions typically come due in 5 to 7 years. In addition, many companies whose debt matured in 2009 and 2010 have been able to extend their loans, but the extra breathing room is only adding to the bill for 2012 and after. The bill is coming due. So, the result is a potential financial doomsday, or what bond analysts call a maturity wall. From $21 billion due this year, junk bonds are set to mature at a rate of $155 billion in 2012, $212 billion in 2013, and $338 billion in 2014. The credit markets have gradually returned to closer to normal since the financial crisis, particularly in recent months, making more loans available to companies and signaling confidence in the pace of economic recovery. But the issue is whether they can absorb the coming surge in demand for credit. And as with the case with the collapse of the subprime mortgage market 3 years ago, derivatives played a big role in the explosion of risky corporate debt. In this case, the culprit was a financial instrument called a collateralized loan obligation, which helped insurers repackage corporate loans, much as subprime mortgages were diced, sliced, and then resold to other investors. That made many more risky loans available. So the question is, should these deals have ever been financed in the first place? The period from 2012 through 2014 represents payback time for a who's who of private equity firms and the now highly leveraged companies they helped buy in the pre-crisis boom years. Biggest include the hospital owner HCA, which was taken private in 2006 by a group led by Bain Capital and Kohlberg, Kravis, and Roberts for $33 billion and has $13.3 billion in debt payments coming due between 2012 and 2014. Another buyout led by Kohlberg, Kravis, the giant Texas utility TXU, has $20.9 billion that needs to be refinanced in the same period. Realogy, which owns real estate franchises like Century 21 and Coldwell Banker, was taken private by Apollo in the spring of 2007, just as the housing market was beginning to unravel and as the first tremors of the subprime crisis were being felt. Realogy was saddled with $8 to $9 of debt for every $1 in earnings, well above the $5 to $6 level that is manageable for a company in a highly cyclical industry. Realogy has survived barely. The company's cash flow is still below what's needed to cover the interest on its debt. Realogy said it ended 2009 with a substantial cushion on its financial covenants and over $200 million available cash on its balance sheet. The company generated over $340 million of net cash provided by operating activities in 2009 after paying interest on its debt, the company said. Chief among those is the best-rated borrower of all, the United States government. The Treasury Department estimates that the federal budget deficit in 2012 will total at least $974 billion, down from this year's $1.8 trillion, but still huge by historical standards. But then again, there is the unforeseen events. Most critics of deficit spending have focused on the budget gap alone, but Washington will actually have to borrow at least $1.8 trillion in 2012 because $859 billion in old bonds will come due and have to be refinanced in addition to deficit. By 2013 and 2014, $1.4 trillion will have to be raised annually, yes, each year. How will this be possible? Continually adding to the national debt. And yes, these are best-case scenarios. In the late 1990s, the federal government ran a surplus and actually paid down a small portion of the national debt. But with the huge deficits of the last few years, the national debt has grown to more than $12 trillion. Yes, $12 trillion. And that's a lot of money. And it's still growing rapidly. What kind of world are we leaving for the future generations? And that includes the financial also. Luke chapter 21, verse 35 For as a snare shall it come on all them that dwell on the face of the whole earth. And these are more signs of the end times. Transition days. There is a transition. It's happening daily all around the world. These are more signs.